Today, we're jumping straight into what might be the biggest puzzle on the market right now.
It's a real head scratcher.
We're talking about Oracle, ticker ORCL. If you just look at the stock chart, it's pure panic.
Yeah, it's been a brutal ride down.
The stock took a massive punishing fall. We're talking nearly 40%. From a peak of almost $350 all the way down to where it is now, hovering around $197.
A drop like that makes people run for the exits. It just screams, sell.
It does. But here's the paradox, the central puzzle we need to solve. Why did the stock crash while the actual business, the fundamentals, they seem to be exploding?
Hitting new records even. It's a complete disconnect.
So the sources we've been digging into present this really compelling counter-narrative. They're arguing this isn't a crisis you should be running from at all.
Quite the opposite.
They're calling it, and this is a direct quote, the golden buying opportunity of 2026. And this whole incredibly bullish idea hinges on one, frankly, jaw-dropping number.
A $500 billion number.
Exactly. A $500 billion contract backlog that this analysis claims the market is just completely ignoring. Okay, let's unpack this.
Yeah, let's figure out if this is just panic selling or if it's genuinely a historic mispricing. This is where you, as an informed observer, really need to look past the fear on the chart.
Right, and look at the actual data that's driving future demand. So let's start there. Section 1, the disconnect. A 40% haircut in a company this big, that's not a small thing.
No, it's significant. It sends ripples everywhere.
So what caused it? What's behind such a sharp, sudden drop?
The analysis we looked at is pretty firm on this. It's primarily a technical thing, not a fundamental one.
What do you mean by technical?
Well, think about the stock's run-up earlier in the year. It went, and I think the word they used was parabolic.
Okay, too far, too fast.
Exactly. When a stock gets that far ahead of itself, driven by pure momentum and, all the excitement around the AI trade, it gets really fragile.
So any little thing can knock it over.
Precisely. The moment a little profit-taking starts, or you get some weird option expirations forcing selling, a big cool-off is, well, it's almost guaranteed.
So this is just a washout of the short-term speculators.
That's the argument. A clean-out, not a genuine concern about the health of the business.
Okay, that makes sense. A rapid rise leads to a rapid fall. But this is the pivot point, right? We have to contrast that technical cool-off with the fundamental heat they just delivered in their Q2 earnings report.
And the contrast is, it's dramatic. While the stock chart was making everyone sick, the business was breaking records.
Let's get into the specifics. Earnings per share, EPS?
It came in at $2.26.
Which was way above the estimates, right?
It absolutely crushed them. The consensus was sitting around, $1.64? It's a massive operational beat.
And what about the core business? The cloud revenue?
Overall, cloud revenue grew a really healthy 34%.
That's a strong number. But there's a number inside that number that's even more important for the AI story.
Oh, yeah. This is the one that really defines their new trajectory, the foundation layer. Infrastructure as a service.
Main growth right there.
Skyrocketed. A 68% year-over-year growth rate.
68%. I mean, that's not just growth, that's wild acceleration. And we're talking about the core plumbing here, the basic computing power.
Exactly. That's why the context is so important. The analysis points out that their cloud, OCI, is really focused on the heavy-duty stuff. Powerful bare metal servers, optimized GPU clusters.
The exact things that these big AI companies are desperate for.
Right. And Oracle is willing to sell them that raw power without forcing them to buy all of their other software on top. That's a key differentiator.
So that 68% growth, it proves they can get the GPUs and scale up their data centers to meet this explosion in demand.
It's definitive proof. So you have this stark contrast. The stock price says sell. It's all fear. But the data, the 68% IASA growth, says buy. It says the structural demand is moving faster than ever.
An unbelievable split in the market. And that fundamental strength brings us right to Section 2. It's the reason the bulls are so confident. The secret weapon.
Here's where it gets really good.
We need to talk about $523 billion.
It's a number that's almost hard to say out loud.
It's gigantic. It's bigger than the entire market cap of many huge companies.
Yeah.
And this number is supposedly the whole reason that the 197 price tag is a generational opportunity.
So for anyone listening who's maybe newer to this, we should probably define it clearly.
Good idea.
That $523 billion is Oracle's remaining performance obligations. The RPO.
In simple terms.
It's the contract backlog.
Yeah.
This isn't a forecast or a hopeful guess. It's money that is guaranteed to come in from signed, long-term customer contracts.
But it just hasn't shown up on the income statement yet.
Exactly. They haven't delivered the service yet, so they can't recognize the revenue. Think of it like a giant construction company with a huge pipeline of signed projects. The money is coming. You just have to do the work first.
So it's secured cash flow just waiting to be counted. What about the growth of that pipeline?
Now that is the explosive part. This $523 billion number, it exploded by 438%.
438%.
438. It's an unprecedented rate of contract accumulation. It means they aren't just closing deals, they're closing deals on a completely different scale.
Okay. A 400+% growth in guaranteed future income? That's undeniable. But let me play devil's advocate here. Let's add some tension.
Please.
If these are multi-year contracts, 5, 7, 10 years, how can we be sure they won't get renegotiated or just canceled if the whole AI landscape shifts? Does the analysis address that skepticism?
It does. And that is the exact question that explains this whole disconnect. The market is skeptical because converting that RPO into actual revenue takes time. Wall Street is obsessed with the next quarter.
Right, they want to see it now.
They do. And a commitment that guarantees cash flow for the next decade creates this accounting lag. But the risk of these contracts just vanishing is structurally low. These aren't small clients. We're talking major AI labs, governments, global companies.
They're building their future on Oracle's infrastructure.
They are. The analysis is very strong on this point. The demand for raw computing power is intense and irreversible. Everyone from OpenAI to even competitors like Microsoft needs it, and they're signing these huge deals with Oracle.
Which brings us back to their strategy. How are they pulling this off, winning these massive deals from everyone, including their rivals?
The report calls their strategic position the Switzerland of AI.
The Switzerland of AI. I like that.
It's a great analogy. You have AWS, Azure, Google Cloud. They're all fighting to lock you into their ecosystem, their specific software, their services.
Right, they want to own your whole stack.
But OCI, Oracle's cloud, is offering a more neutral high-performance platform. They'll sell you the raw power, the infrastructure, and they don't care as much about what you run on top of it.
That neutrality must be a huge deal for AI companies. They need flexibility.
It's everything. You need to be able to run your models anywhere without being locked in. Oracle is selling the essential, unopinionated stuff, the highways and the power grid that everyone needs. They're an unbiased, essential provider.
So if we circle back to that 197 stock price, the argument is that you're not just buying their old database business. You're not even just buying their current cloud revenue.
No. You are buying a ticket.
A ticket to that $500 billion stream of guaranteed contracted income that's going to flow into the company over the next few years.
That's exactly. It completely changes how you have to value the company. You can't just look backward with a simple PE ratio. You have to look forward at the secured pipeline.
Which is the perfect transition. It brings us to the core question for any investor looking at this. What does all this mean for valuation and for price target?
Well, this is where it gets almost comical. Despite the insane growth numbers we just talked about, the valuation is surprisingly modest.
How modest are we talking?
Right now, Oracle is trading at a forward price to earnings, or PE, of around 26.
26 times forward earnings.
Okay.
Given that 68% IIS acceleration and the 438% RPO growth, is that actually low?
The analysis says it's dramatically undervalued. I mean, think about it. Other stocks that get called AI flyers are trading at 50, 60 times earnings.
Often with lower growth rates.
Often with much lower growth rates in their core infrastructure. That 26x PE suggests the market is still pricing Oracle like it's a slow-growth legacy database company.
Not a hyper-growth AI infrastructure provider.
Exactly. And that gap, that mispricing, is the entire opportunity.
So let's put some numbers on that opportunity. What are the specific price targets in the sources, starting from this 197 level?
The average, more conservative Wall Street price target is sitting around $300 to $1.
Okay, so that's the consensus. What about the real bulls?
The bulls, the ones who are really focused on this huge backlog, they're pushing for $400 or even higher. They believe that once that RPO starts hitting the income statement, the valuation gap just has to close.
So let's just do the simple math here. A move from 197 up to the average target of 301. That's a 52% gain.
A 52% gain just to get to the Wall Street average.
And if that bull case plays out, if they hit $400, you're looking at a 100% gain, a double.
A double bagger, as they say. The potential is significant.
Usually that kind of upside comes with a ton of downside risk.
Yeah.
Does the analysis offer any comfort on that front?
It does, actually. Yeah. It highlights that the downside seems pretty limited. And there's strong technical support cited right at the $190 level.
So a very tight floor, just below where it's trading now.
A very tight floor. So when you weigh that limited downside against a potential 50 to 100% upside, an upside driven by guaranteed contracts, the risk to reward is just, the analysis says it's screaming buy.
Fascinating. So let's bring it all home. Let's summarize the verdict from the analysis.
The verdict is that the market is fearful. It's being driven by a technical cool-off after a massive run.
But the fundamentals, especially that $523 billion backlog, reveal a completely different story.
The story of rapidly increasing intrinsic value. The final call is that there's a massive but temporary disconnect between the price of the stock and the value of the business.
And they put a timeline on when that disconnect might close.
Yes, and that's crucial. They expect the stock to start reclaiming its old highs and then push for new records, specifically as that backlog converts into recognized revenue. They're targeting the 2026 fiscal year for major impact and market recognition.
So it's about the market finally seeing that guaranteed future revenue hit the official income statement.
That's the catalyst. It's a long-term play based on contract certainty.
All right, so given that enormous accelerating IaaS growth, that staggering 68% number, and this really strong strategic position as the neutral Switzerland of AI, here's a final provocative thought for you to consider.
Let's hear it.
Is Oracle simply the best or maybe just the least recognized AI infrastructure play left on the board right now? I mean, think about it. If that $523 billion is truly guaranteed contracted revenue, what does that level of certainty mean for long-term compounding growth? And just how much is the market underestimating the sustained free cash flow this backlog promises for the next 5 years? Think about the power of knowing exactly where your revenue is coming from.